But could it all be unraveling? Well, the signs are there. Germany is thinking about bringing back its gold from the United States. As you know, every country has a gold reserve. They stock up bullions for stability. But some of those bullions are stored abroad, mainly in London and New York.
A storm is brewing deep in the vaults beneath Manhattan, two of Europe's largest economies. Germany and Italy are quietly preparing to withdraw more than 1,930 tons of gold from the Federal Reserve Bank of New York. This move, worth over $29 billion at current market prices, could ignite a global financial shift with consequences stretching far beyond central bank accounting. At the heart of this gold exodus is a crisis of confidence. Since the end of World War II, the United States has served as the custodian of Allied gold reserves, its vault seen as the most secure on Earth. But that legacy is being tested under increasing political pressure at home, and amid trade tensions with the United States, leaders in Berlin and Rome are signaling a new era, one defined by monetary sovereignty, strategic leverage, and deep skepticism toward Washington's stability in Berlin. The far-right alternative for Germany, AfD party, has turned the gold issue into a national rallying cry for years. AfD has demanded the repatriation of German gold held abroad, citing fears of seizure, dollar volatility, and overdependence on US-led financial systems. Now that movement has found unexpected momentum, leaked reports indicate that Germany's Bundesbank and Italy's Bank of Italy are planning weekly cargo flights using NATO standard aircraft such as the IL-76 and C-17 Globemaster to ferry the gold back to Frankfurt and Rome in highly coordinated operations over the next 8 to 10 weeks. In Germany, the implications are vast. Roughly 1,236 tons of its gold, nearly one-third of its total reserve, is still housed 24 below street level in the New York Fed. For Italy, that number is 700 tons, representing a significant portion of its 2,451-ton reserve. Together, these two nations account for the majority of non-US sovereign gold stored at the Fed. Supporters of the move cite economic prudence and historical precedent. Between 2013 and 2017, Germany successfully repatriated 674 tons of gold from Paris and New York. Without incident, that operation proved that logistical and security hurdles could be overcome, but this time the context is different. The world is entering a new era of deglobalization, energy fragmentation, and contested currencies. Holding strategic assets like gold at home is no longer merely symbolic. It's a hedge against the uncertainty of a reconfiguring global order. The political calculus is also evolving. Chancellor Friedrich Merz of the center-right CDU, once a proponent of US-European financial integration, now faces increasing pressure from both populist forces and centrist voices in his own party European Parliament. Member Markus Ferrer, a veteran CDU policymaker, recently warned that Trump's unpredictability and willingness to politicize the Fed could make foreign gold holdings vulnerable. Meanwhile, the German Taxpayers Association has submitted a petition calling for full repatriation, citing transparency and legal control across the Alps. Italian Prime Minister Giorgia Meloni is navigating her own political minefield while initially hesitant to antagonize Washington. Meloni now sees the gold issue as a powerful bargaining chip amid ongoing trade disputes with the Trump administration. Her government has even revived plans to construct a secure vault nicknamed the Villa Borghese Reserve on the outskirts of Rome to house the incoming bullion. Behind the scenes, central banks and financial regulators are preparing for potential market turbulence. Though the Fed insists that these gold transfers are standard accounting procedures, the optics are another story. A sharp reduction in foreign central bank gold deposits on the Fed's balance sheet, estimated at nearly $30 billion in the first month alone, could rattle investor confidence and stoke speculation about broader dollarization efforts. Analysts warned that the withdrawal could trigger secondary effects across U.S. financial markets. Treasury yields, already sensitive to liquidity conditions, could rise by as much as 10 basis points due to perception-driven selling pressure. This would reverberate through the mortgage market, corporate debt issuance, and municipal bond financing in a worst-case scenario. Upward pressure on rates could drive up debt servicing costs for the federal government, which already faces a projected $770 billion interest bill in 2026. Gold's symbolic power is also growing, according to the Bank for International Settlements. Gold now makes up over 20% of global central bank reserves, up from 11% 2 decades ago. If Germany and Italy's example prompts other medium-sized reserve holders like Austria, Belgium, or the Netherlands to follow suit, gold's share could rise to 25% by 2028. Such a shift would come at the direct expense of dollar-denominated assets, potentially reducing demand for U.S. Treasury securities by hundreds of billions of dollars. This trend has caught the attention of policymakers across the Atlantic inside the Federal Reserve. There are whispers of contingency plans. One option includes allowing foreign gold to be used as collateral in U.S. repo markets, a controversial move that would effectively monetize bullion and create a new asset tier within the Fed's balance sheet. Another path involves expanding swap lines, with the European Central Bank and the Bank of England offering dollar liquidity in exchange for euros and sterling in an effort to stabilize exchange rates. Yet these solutions carry risks of their own. Critics argue that they could undermine the dollar's reserve currency status by introducing structural alternatives once gold becomes part of the settlement infrastructure. Or worse, once U.S. control over that gold erodes, markets could begin pricing American debt with an added risk premium over time. This could force a re-evaluation of the so-called exorbitant privilege the dollar has enjoyed for decades. At the center of it all is trust. Trust that U.S. institutions will honor financial commitments. Trust that political turmoil will not jeopardize foreign reserves. Trust that holding dollars or dollar-dominated assets is as good as holding gold. That trust, once considered immovable, now trembles under the weight of shifting alliances, rising nationalism, and strategic hedging in the halls of Brussels, Paris, and Tokyo. Finance ministers are watching closely. Could this be the beginning of a broader movement in an age where central banks are expanding digital currency pilots and rethinking energy financing? Gold may be regaining its ancient role, not just as a store of value, but as a symbol of financial independence. For Washington, the moment is sobering. For Berlin and Rome, it is strategic for the rest of the world. It is the clearest sign yet that a new global monetary order is taking shape quietly, ounce by ounce, in cargo planes flying under the radar. If this gold repatriation trend continues, we may be looking at the beginning of a significant reallocation of global capital. Sovereign wealth funds, which manage over 11 trillion globally, may begin rebalancing portfolios to reflect decreased confidence in U.S. paper assets. Some experts predict a revival of bilateral trade settlements in gold, or at least a diversification away from sole reliance on the U.S. dollar. Even global development institutions are taking notice. At recent IMF meetings, several emerging market nations raised the prospect of a gold-linked lending framework to mitigate dollar volatility in development finance. This could lay the groundwork for a parallel credit system, subtly challenging the IMF's existing tools and raising new questions about the global hierarchy of currencies. Gold is also returning to the public consciousness. Retail demand for bullion has surged in Europe, particularly in Germany, Austria, and Switzerland, where public distrust in paper currency is growing. Central banks in Asia have quietly increased their reserves, led by China and India, in what analysts call a preemptive move against dollar dependency risks. The broader psychological impact of the repatriation is perhaps its most powerful effect. It signals that even the most reliable, long-standing financial relationships are not immune to political winds and changing global dynamics. The sheer act of moving gold, long hidden and silent, becomes a message. Sovereignty matters, and trust must be earned. Let us know what you think in the comments below. Will this spark a domino effect among other countries? Is the U.S. prepared for the long-term consequences of eroding confidence in its reserve system? Subscribe to the channel and stay tuned as we continue covering the stories that shape the future of global finance.